Hey everyone, welcome back to Maverick. In today's video, we'll be discussing a crucial yet often overlooked aspect of the banking sector: why banks should be allowed to fail. If you're new to the channel, be sure to hit the subscribe button and the notification bell so you won't miss any of our future content. Now let's dive right in. Our first reason is that allowing banks to fail encourages responsible risk management. When banks know that they will be bailed out, they have less incentive to be cautious in their lending practices and investment strategy. This can lead to excessive risk-taking, as seen in the 2008 financial crisis, where banks engaged in subprime lending and complex financial engineering. By letting banks fail, we force them to be more prudent in their decision-making, thereby reducing the likelihood of a financial crisis. They will be incentivized to strengthen their balance sheets, reduce leverage, and ensure they have adequate capital buffers to absorb losses in the event of an economic downturn. Another reason why banks should be allowed to fail is to level the playing field. Government bailouts tend to favor the largest banks, as they are considered systemically important to the financial system. This creates an unfair advantage and perpetuates the too big to fail problem. By allowing banks to fail, we give smaller, more innovative financial institutions a fair chance to compete. These smaller banks can bring new ideas, technologies, and business models to the market, fostering competition and driving improvements in the industry. This ultimately benefits consumers, who can enjoy better services, more choices, and lower fees. Moral hazard is a significant concern in the banking sector. When banks believe they'll be protected from the consequences of their actions, they're more likely to engage in reckless behavior. Bailing out banks that have acted irresponsibly sends the wrong message, as it rewards poor decision-making and punishes the prudent. Allowing banks to fail helps to reduce moral hazard by holding them accountable for their actions. It sends a clear message that risky behavior will not be tolerated, and that banks must bear the consequences of their decisions. This, in turn, encourages better risk management and decision-making in the long run. Market discipline is a critical component of a stable financial system. It involves investors and consumers monitoring and rewarding or punishing banks based on their performance. When banks are allowed to fail, market participants have a strong incentive to monitor banks' health and make more informed decisions. For example, depositors may choose to move their money to a more stable institution if they believe their current bank is at risk. Likewise, investors will be more discerning about which banks they invest in, leading to a more efficient allocation of resources. This increased vigilance ultimately contributes to a stronger and more resilient financial system. Our final reason for allowing banks to fail is to reduce the burden on taxpayers. When the government steps in to bail out struggling banks, it's typically funded by taxpayers' money. This means that the cost of failure is shifted from the bank's shareholders and managers to the public. This is both unfair and inefficient. Taxpayers should not be responsible for covering the losses of private institutions that made poor decisions. By allowing banks to fail, we ensure that the costs are borne by those who have profited from the bank's success. Shareholders and bank executives will have more skin in the game, making them more vigilant and careful in their decision-making. Additionally, this approach helps to maintain public trust in the financial system, as it demonstrates that the government is not favoring big banks at the expense of taxpayers. In conclusion, allowing banks to fail has numerous benefits, including promoting responsible risk management, leveling the playing field, preventing moral hazard, encouraging market discipline, and reducing the burden on taxpayers. A resilient financial system requires banks to face the consequences of their actions and learn from their mistakes. By letting banks fail, we can foster a more stable, competitive, and accountable banking sector. That's it for today's on why banks should be allowed to fail. I hope you found this video insightful and informative. If you enjoyed it, please give it a thumbs up and share your thoughts in the comments section below. Don't forget to subscribe to our channel and hit the notification bell for more videos like this. Thanks for watching, and I'll see you in the next one.